Welcome to the 13th edition of our podcast series, Talking Data, which offers timely insights into macro data and its impact on the economy and markets. I'm Kristen Radish of Arbor Research and Trading. I will be today's moderator. Our podcast features Jim Bianco of Bianco Research and Ben Breitholtz of Arbor Data Science. Today's topics are inflation, bond issuance, and the bond vigilantes. Ben, we're going to get started with you today. First, U.S. CPI disappoints away from core commodities. Are tips break-evens attractive right now?
Yeah, so the issue here is that the big inflation that we saw over the summer is kind of fizzled. A lot of it had to do with lack of inventory. We saw it heavy in used car prices recently. The Manheim used car price index actually dropped last month for the first time in a number of months. So some of that's going to fade away, and wouldn't be surprised to see CPI core and headline drift towards their long run averages around 0.1 to 0.2% on a month-over-month basis. So investors are still keeping a firm floor at about 1.5% on a year-over-year basis for CPI. I think that remains pretty firm, meaning that if you get out to 10 to 30-year break-evens, that 150 basis point level is attractive. Now that's some 20 basis points away from where we are now. So we don't necessarily think they're great in this current location. I think they could churn sideways to narrow in the near term, looking into year end. And really the question is, do we see real, lasting inflation? Are they going to build that in? Because Jim, when we were discussing earlier, and I'll pass it over to him, had a great point about the liquidity premium that's been sucked away from break evens that most people don't really think about.
Yeah. Who's the biggest buyer of tips right now? And the answer is the Fed through quantitative easing. Who's the biggest buyer of nominal interest bonds? Is the Fed through quantitative easing. So the Fed has their thumb on the scale quite a bit when it comes to tips break evens, and they are probably the biggest influence in setting where those rates are. And you can look at that. The other thing that I find it's interesting too is that another favorite metric that the Fed looks at are the inflation surveys. I know, warning, we're going to talk about surveys here. University of Michigan, the Conference Board, these are the consumer sentiment surveys. They also ask you about inflation. Those are up too, quite a bit. Now, a lot of that, what you're seeing in the consumer confidence surveys on inflation, the inflation question, is about rising food prices, because we did see a big rise in food prices. Nobody went out to restaurants. They all started going to the grocery store to buy food, so food prices went up. And so that's what's driving that, but that's still elevated as well too. But let me turn it over to you, Ben, about back on tips. What are your modeling showing us about the influence that the Fed may be having on the tips break-even market?
Yeah, so if we decompose, and we can do this, a simple way, just with some nice, kind of fancy regression models, or we can use some of the academic studies and really let's break up tips into the liquidity premium, kind of a risk premium, and then also the true inflation premium. And when you do that, you can do this many different ways, but they're almost all unanimous that the liquidity premium, the degree of bid ask, just in terms of trading tips and the ability to basically move sizable positions, has dramatically improved thanks to the Federal Reserve. And what that results in is that premium is absolutely collapsed, and in certain cases have actually gone negative across the curve, meaning that liquidity is so good. Now that might not necessarily be the case. Maybe it's not easy to push 100 million in tips through the market, but I think it goes to show that the inflation premium within a lot of these models and our own modeling is scant, if at best, in terms of actually adding to tips break even. So that's why we're at this critical juncture. Do we get inflation? Can we actually add, create an inflation premium in tips break evens or not? And I think Jim is spot on that the liquidity issue has been the story now, historic, looking back. And now investors need some real impetus here to keep the train going, and I don't think that's going to happen over the next number of months.
So count me as one of those that thinks that the inflation story will be noteworthy as we move forward from here. And I'll remind you my argument. My argument is on the supply and the demand side of the equation. On the supply side of the equation, the economy has contracted from last year. Just simply GDP, there's less GDP now than there was a year ago. Gross domestic product. we're producing less product now, so we have a reduction of supply. We have fiscal stimulus, we have monetary stimulus, excuse me, and the promise of more fiscal stimulus probably after the election, which is only 3 weeks away right now. That's going to keep demand higher. Even today, Trump tweeted out again, he's in favor of doing more stimulus than even Pelosi wants. And the only thing that's holding him back right now is the Republican Congress. That will stimulate demand. Less supply, more demand, higher prices. That's a fancy way of saying inflation. I'll mention again, core PCE, personal consumption expenditure. That's the Fed's favorite model metric of inflation. It hasn't been above 2.5 since 1993. So if we get it to 2.5 at a 27-year high, I will then say, look, it's a 27-year high. We now have some inflation moving maybe towards more if we get to that point as well too. So when I say we're going to get inflation, I don't want to be confused with, I think 7 or 8 or 10% or something like that. I'm talking about 2.5 on core PCE. When do I think we could see that? I hear you, Ben, that the numbers are slowing down a lot because it was an inventory issue that pushed up prices up until a few months ago. But I think once we get the year-over-year numbers through the lockdown, and it's so April, May of next year, I think we're going to see much higher core numbers, and I wouldn't be surprised if we start challenging that 2.5% level. What say you about inflation being noteworthy from here?
Yeah, so what I'll say is that I think it's going to be kind of a dead story through a year end, and I think the key here is we've had such a great revival in retail consumer spending. Some of that has begun to somewhat slow over the past 2 to 3 weeks. Some on the lower rung since FPUC payments ended in July. I think it's going to be imperative that we're able to keep that trajectory going. So it can plateau, it just can't crumble. And I think if it ever showed any signs of crumbling between now and January or February of next year, that's when I think the story that you're talking about gets pushed even further out into the future. But getting back to it, I still think with the firm floor that investors have put in place at 1.5% year over year, there's an attractive level in terms of owning that within a portfolio to hedge against this potential scenario next year. So I wouldn't rule out tips break evens by any means in terms of actually helping diversify.
Yeah, I would agree with you. And I would also, just to finish up on this section, just say, I do think that the inflation story is going to be the story of the next year. Either it comes back with a $3 trillion deficit, which would be my bet, again, 2.5, not some major number, or doesn't. And if it doesn't come back, I think that that's going to be a real story as well, too. We'll have to see. But let's move on. Kristen, what's our next topic?
Jim, why don't you discuss specifically the Fed? We talked about the Federal Reserve. Is it going to it's keeping a tight leash on volatility. Issuance will be ballooning, but is this quantitative easing forever?
Yeah, so we had some news yesterday. Fed Governor Randy Quarles spoke virtually at a conference for the University of California, Irvine, and I'm going to read you his quote. It may be there is a simple macro fact that the Treasury market, being so much larger than it was a few years ago, much larger than it was a decade ago, and now really much larger than even a few years ago, that the sheer volume may have outpaced the ability of the private market infrastructure to support stress of any sort there. And then he went on to say that the Federal Reserve will probably be doing QE or some version of intervention in the Treasury market like we've seen forever, permanently as well too. This reminded me of the old line, there are no bad bonds, there's only bad prices. Randy Quarles, I guess, hasn't learned that lesson, that the private market will sell your bonds. You may not like the price, but it will sell your bonds. He's basically saying that without the Fed, you won't like the price. We, the Fed, won't like the price of bonds. So we're going to stay in there, continuing to purchase bonds, QE forever. And I think, by definition, suppressing interest rates by taking out any kind of liquidity premium because they're going to be there, or any kind of of other kind of a stress point premium in the marketplace as well too. I'm going to come back to our earlier point. Will this work? Yes, until or unless we get inflation. The Fed can play in these markets. They can set the interest rates in these markets. They can do a lot of anti-capitalist things in markets that would make a lot of people shake their head if it doesn't have a perverse outcome. But if there's a perverse outcome like inflation, then what the Fed is doing is bad. And if it's bad, the market's going to demand that the Fed stop it. Ben, what's your thoughts on this?
So I think the Fed is underneath the surface here, gearing up for not yield curve control, but for actually extending purchases further out the curve. So we've all watched the curve steepen, the Treasury curve steepen, particularly look at like 5s, 30s. And with that being said, I think all the heavy issuance and the potential tilt of risk is looking bearish to higher yields, lower prices for Treasuries, and that's exactly how investors are positioning. So one of my favorite metrics is looking at swaptions. Let's look for what's the premium for protection against a negative 25 versus a positive 25 basis point move on 30 years, and that's tilted just heavily to the bearish side. So I think that the markets, like you're saying, are thinking that yields could rise on all this issuance. If even if we just get a modicum, just a small amount of inflation, we could see yields rise, and they want to be hedged for that. So on the flip side, the Fed's going to want to compress any type of situation where the long end gets out of control. And I think the big pain trade potentially, if it did happen, was if everything kind of hits the fan and there's also no true rush to safety to Treasuries, which hasn't happened really since March and April. The pain trade would be lower yields because everyone's getting positioned for this higher yields. But that lends to Jim's point, your point, that without the Fed maybe purchasing, and even with the guidance to purchase, without that, yields would be creeping higher. We're exactly where we should be in terms of the cycle based on past global slowdowns, and yields should be rising, and that's typically what investors allow to happen. So if that doesn't happen, it means someone's compressing them, and that's likely the Fed. And I think they could continue to do that. I wouldn't be surprised next 2 months to see them extend purchases out the curve.
And as far as them being aggressive and out the curve too, their support of the credit markets becomes kind of an interesting aspect too. The Fed, with a lot of fanfare back in March, announced a program to buy corporate bond ETFs and high yield ETFs, not the high yield bonds, but the ETFs. And they also said a big fanfare on a program to buy investment grade corporate bonds. They took 2 months to roll those programs out, but they're out now and they're there. As far as the ETFs go, it's now been almost 2 months since the Fed has bought another ETF. They bought some early. I think they bought like $12 billion in total or something like that, but haven't bought any in like 6 or 7 weeks. They've been very aggressive in their purchases, at least initially, of corporate bonds, and they've slowed that down too. But bear in mind that the programs are in place now, and it would just take 10 minutes and one phone call to ramp them back up. I'm reminded of the famous line from the ECB president, Mario Draghi, from July of 2012, when we had the sovereign debt crisis and we had Italy and Spain and Portugal and Greece trading at 8, 9, 10% yields. He said that they would do whatever it takes to solve this crisis. And what did he actually do? Nothing. He just said whatever it takes. And that was enough that the market actually compressed its yields. He never actually had to follow through and do anything after that as well too. And I feel like now that these programs are in place and it's one phone call away from purchasing them, they maybe don't have to do those purchases, but nobody wants to go against the Fed. Remember that on Wall Street, the big battle cry, Bob Michael of JP Morgan Investment Management. Bob, what do you think about corporate bonds? He was once asked on Bloomberg TV. I want to co-invest with the Fed. How could you go wrong? Buy the bonds that the Fed's buying, because if the market tanks, they're going to print money and make sure they go back up. I'm in with the Fed. It's basically what he said. he's been right. That's been a very good strategy to work with. And I think that that is permeating a lot of these markets. So the Fed supported the credit markets. My point is it's there. Even if they don't buy, it's just the threat is good enough for right now.
Well, heck, look at triple C versus triple B OAS, which was blown out to 1,500 basis points in March. Basically peaked, I think, on March 23rd with the SMCCF getting announced. That's compressed all the way down to around 713, maybe 712 basis points at this moment. And I think that it's going to be interesting as we get close to the long run average for that spread, which is somewhere around maybe 650, 660 basis points. It's kind of like a mission accomplished for the Federal Reserve. And same thing we can say for implied volatility. If you look at LQD and investment grade corporate credit, or you look at an HYG at their implied volatilities, those have also compressed. If you look at on the 3-month basis, it's right around 9%. So that extra premium in vol that high yield had is completely gone. So another check mark for the for the Federal Reserve. So I would agree. I think that the Fed could always come in really quickly and help basically quell markets. But I think we're getting now to the point where spreads are back to long run averages, especially in the junkiest end of the credit market. Vol is so low and now so interconnected between high yield and investment grade debt that now is the point at which we're going to start to get some maybe a higher dispersion. And I think that's when things will get a little more interesting for credit investors moving forward. It doesn't mean that we're going to blow out. And I think Jim's right that the Fed will swoop in if they have to. But as we get to these kind of critical points, I think that we'll see kind of a bottom in volatility and maybe a little bit of a kick up, dust up in dispersion, especially if we get a little bit of weakness in the economy.
I'll just conclude this section by reminding you all this works and it works well, and we could send all the Fed chairmen and governors to Oslo to give them Nobel Prizes in economics, as long as there isn't an adverse outcome like inflation. All this works great. But you get some kind of adverse outcome like inflation and the perception in the marketplace that these programs are making it worse, and then it all goes sideways. And that's what I think my fear is. We'll see if that happens. Kristen, how about our last topics? What's that?
Thanks, Jim. So Ben, I'm going to turn it over to you to talk about the quest for safety or safe havens. Will U.S. Treasuries offer diversification, and where are investors to turn?
So that's been difficulty, really since April or so. If you look at flows, Treasuries as an asset class have really been not loved. There hasn't been that much money thrown into it. All the money going into fixed income is going into what Jim was just talking about, which is investment grade credit, munis, MBS, TIPS, and so on. So it's been the 60-40 portfolio, of course, is under major scrutiny. Of course, every time we seem to do this, it seems to go on to its best year ever. So we'll see what happens. But I think with what we just discussed, the environment where everyone's getting positioned kind of bearishly on Treasuries, but you still have the Fed that's going to keep a leash on volatility. Treasuries are going to be a tough sell as a diversification tool. And there's some inkling or some rebound right now that we're seeing in the correlation between treasury yields and the S&P 500, for example. I think that on a rolling one month basis is almost back to 0.45 or 0.5, meaning that they're kind of moving a little bit more together, which isn't what you want to see. So you kind of, where you lose on bonds, you're also losing on equities. So, where can you put money? Where can you really turn? And I think that's why we've seen such heavy flows into things like gold, oddly enough. Usually I'm not a big proponent or fan of gold, but within a lot of our models, based on what Jim just said too with inflation and also any kind of economic policy uncertainty, I think some of the precious metals do actually somewhat make sense and will offer some of that diversification opportunity. And the dollar has been so negatively correlated to that, and that's been kind of the outlier. The dollar's volatility and its return relative to other asset classes has been pretty negatively correlated, if not non-correlated. So I think that space remains somewhat attractive. The other one is just, for those that are willing to take the risk further out the curve, further out this risk spectrum in credit, going out to double Bs, triple Cs, that's where all the funds been for the most part. I think still holding a larger amount of cash kind of makes a certain amount of sense in this environment.
So let me challenge the premise of the question too about diversification. In a disinflationary and a deflationary environment, which is what we've been in since the late 90s, you tend to get assets with with negative correlations to each other. Of course, the big one is bonds and stocks. They seem to prices move opposite each other, which is what's made the 60-40 portfolio such a gigantic winner. One of those legs is always going up depending on what kind of environment you are in. A bad environment, Treasuries rally. A good environment, your risk rallies like stocks. You get to an inflationary environment. Yeah, I'm Johnny One Note on this podcast today. You get into an inflationary environment, and what we found from previous inflationary environments is all of the correlations are positive. Stock, bonds, commodities all go up together, they all go down together. And then people say, well, how do I diversify? The answer is you don't. Your money goes to heaven is basically what happens, or you wind up making money if you're on the right side of the trade. So this whole premise of there has to be a negatively correlated asset to equities that I could put in my portfolio to offset it is premised on the fact that we are in a disinflation to deflationary environment where something is moving up. But you get into an inflationary environment, and yes, we're not in it now, but maybe the fear is it's coming, then everything goes up and down together. And there is no diversification, if you want to think about it in those terms, other than something like gold or cryptos or something that most people kind of frown upon as well. So I would just throw out the premise here is predicated on a certain type of environment, which we are still in. And the question is, a disinflationary, deflationary environment, will we still be in it by the end of next year? We'll see, where I stand on it.
And I think that's why, so currencies, Forex vol is so much higher than everything. And I think there's an interest, there's been a shift over the past few months from potentially, finding that diversification in treasuries and actually trying to look into the Forex market to a certain capacity. And I think that's something we'll continue to see. Now that's a difficult, trading currencies and dealing with all the different components, geopolitical and inflation and so on is not easy, but I think we're seeing increased interest in that space. I would not be shocked to see more and more, portfolios and individuals turn to some kind of Forex overlay, so to speak, in order to get that diversification. And that'll be more of a sign of the frustration that treasuries are either range bound or what you just said, Jim, that they are now not offering the diversification, the protection they have really for decades for most traditional portfolios.
Yeah, let's wrap this up, Kristen.
Yeah, I was going to ask if each of you could just give your final thoughts for the day.
I'll go first. In 2020 is an unusual year on a lot of different levels, from politically to economically to socially on down the line. And really the question becomes, is it marking some kind of a change, or will there be a change as we move into 21 and 22? And that's really the question. And I think the answer is yes. And then I think the answer is what? That's where it becomes a little bit more difficult. And that's kind of where my thinking has always been, is that I think that there is going to be some kind of a change, because we've seen it with fiscal spending and with monetary policy and with the contraction in the economy, but there also might be some other changes as well too. So I just want to point that out, that's where I'm at, is that we're at the precipice of some kind of a change. And yeah, I mean, I might be wrong on the inflation part, but I think when you go back and look at by the end of 22, we're going to say, yeah, a lot of things changed. We may have got right what changed, but I don't think we need to say, okay, let's look back the last 3 years and say that's going to look like that the next 3 years. Such a big events have happened this year. I think we're going to see some bends in some of these trends. Ben?
Yeah, so I think inflation, I think, will be muted through year end, and we'll see if Jim's right for for next year. Obviously a lot of the proper things are kind of stacking up to produce inflation. We'll see if we get it, but I still think seeking inflation protection makes sense at the right levels. I still like 150 basis points further out the curve. I think that the Fed will, move to some kind of, extension of purchase activity and try to basically squash the yield curve to a certain extent. I wouldn't be shocked to see that. Jim and I were kind of agreeing in our last podcast that we still think, there'll be some higher Treasury vol going toward year end, but not by a substantial degree. And I think that investors are going to increasingly try to seek, other safe havens than Treasuries. Again, I think the Forex markets are going to become more and more of a popular venue for that. And so we'll see what happens. A lot can change now with the election and everything we're getting into with COVID here into year end. So exciting, scary times at the same time.
Well, thank you, Ben, and thank you, Jim, for joining us today. We really appreciate your thoughts and comments. And thank you to our audience for joining us. Be on the lookout for a conference call next week with Jim. And as a reminder, Arbor Research and Trading is an institutional research and brokerage firm that produces innovative research across a broad range of global fixed income, equity, currency, and commodity markets. Bianco Research and Arbor Data Science are our two most prominent research offerings. For further information on Arbor Research, Bianco Research, and Arbor Data Science, please contact Gus Handler at gus.handler@arborresearch.com.